Welcome back to Market on Close. Of course, this week's highlight is the Fed and inflation around it. Collin Martin, Director and Fixed Income Strategist, joins me for refocusing on the big picture this week. So, Collin, firstly, with the Fed, FOMC, thinking about the projections, I guess, would be the most interesting part of that this week?
Yeah, that's right, Oliver. We're not expecting any change to policy in terms of the Fed funds rate, any changes to their balance sheet plans because they've already announced that. So it really does come down to the updated summary of economic projections, where we'll get both a look at where they think the economy and how they think it'll evolve, but also the projected number of rate cuts. I think that's really what the markets are going to be focusing on. If we look at where we were in March, the median projection suggested 3 rate cuts this year. So they were projecting a year-end rate in the 4.5 to 4 3/4 range. It seems highly likely that that's going to be revised up. So a higher year-end rate than was projected just a few months ago, implying fewer or less cuts going forward. So we're going to be focusing on that. We're not sure if it's going to be revised down to 1 or 2 cuts. What's also going to be important is not just the 2024 number, but 2025 and especially the long run. And if we look at the long run, Oliver, I think that's important because that's the so-called neutral rate, where the Fed sees the eventual landing place, policy that's not too tight, not too easy, that allows inflation to come down while still having a healthy economy. And we saw that tick up a little bit in March. So that long run rate ticked up to 2.6%. There's been comments out there about the potential that it maybe is a little bit higher than what market participants expect, than what Fed officials expect. So we're going to be paying a close attention to that longer run rate, because if it does get revised higher and that ultimate landing place for the Fed funds rate throughout this cycle is higher, that has implications across a wide range of investments, specifically treasuries. It means that there's likely less room for treasuries to fall once those rate cuts arrive.
And for the volatility along the curve, where do you think that is kind of most going to be this week if we take into context inflation too? So, we could be getting growth outlook revisions from the Fed. We could be getting policy, revision outlooks from the dots. And then we could be getting some fairly longer term. We got long-term implications last week with the big sell-off around the jobs data. But what's interesting is that our curve has kind of remained stable. The 10s to 2s didn't really change so much. They're kind of like moving in sync.
Yeah, they've been stuck at that 40, 50 basis point range for a little while now. And we don't expect that to change until there's clarity that those rate cuts are going to arrive. And that's been our case for a while now. And that as long as we expect the next move by the Fed to be a cut, we think that yield curve will be inverted. And then once those rate cuts arrive, we'll likely see short-term yields fall more than long-term yields, and we'd see a re-steepening and then hopefully a positively sloped yield curve. One thing we are going to be focusing on, this ties into the dots, Oliver, but are those updated economic projections, because that's how they come up with those dots. How do they see the economy evolving? I'm not sure we're going to see too many changes there. If you look at the unemployment rate, they were projecting the rate to be around 4% at the end of this year and the next two, give or take a tenth each year. Considering we're at 4% right now, I wouldn't expect that to change much. And if you look at core PCE, they were projecting a core PCE rate of 2.6% by the end of this year. We're in the 2.8% area right now, so we're pretty close. So I don't think we'll see too many changes as it relates to those economic projections.
Okay. And as long as the general economic trajectory isn't changing too much, then I guess the strategy from a corporate credit side basically remains the same. High quality, don't get too exposed to the lower end of either quality or like rate sensitivity.
Yeah, that's right. That's been our case for a while now. We've had an up in quality bias, and our main rationale for that is just the tight level of spreads that we've seen across the credit spectrum. We think it makes sense to take risk if you're being compensated for it, and that's really not the case with things like high yield bonds right now, where average spreads or the yield you earn over comparable treasuries is only around 3%. That's pretty close to the cyclical low. It's well below the long-term average. So we just don't think it makes too much sense. Now, it doesn't mean you need to abandon high yield bonds. It doesn't mean you shouldn't consider them at all. If you're a long-term investor and you're willing to take risks, I think that's a key point. Because if you think about high yield bonds, they're issued by lower rated, highly indebted companies. There's a reason they have those low credit ratings, and they can be very volatile. but they offer those high yields. So the all-in absolute yields are around 8%. So again, a lot of that yield comes from just the yield of the level of treasury yields, not necessarily spreads. But again, 8% is pretty attractive. So if you're willing to ride out the ups and downs, we think they can make sense for long-term investors, just in sort of an equal weight strategic allocation. But for most investors, and we think most investors are really looking for safety with their fixed income investments, if you're willing to take just a little bit of risk, we do really like the investment grade corporate bond market. Spreads are low there as well, but I think the risk is significantly less. They have those investment grade credit ratings for a reason. You can get yields of around 5.5% or more. We think that's pretty attractive.
We've heard a couple stories last week really highlight some of the wall of loans that are coming up for some of the riskier stuff, but I guess that's in the category that you're avoiding.
Yeah, not avoiding though, just not overweighting. But that's the risk we're seeing is if you look at, say, bank loans. So they're a type of junk debt, but they have floating interest rates, meaning their coupons essentially reset with short-term rates. And high yield bonds tend to have short maturities, so they're very exposed to a higher for longer policy by the Fed. So the longer the Fed holds at its peak level, that's really going to weigh on those indebted issuers. One, because they have a lot of debt. So that really impacts their bottom line. And because they have short-term maturities or even floating rate maturities, they're seeing that rise in interest expense much faster than, say, an investment grade issuer who has a much more diversified funding base.
Okay, great stuff, Collin. Good chat. Nice platform for us to do our work for the rest of the week and ready to trade bonds here on a busy one. Thank you very much.